This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Douglas Raggio of Bias and Blind Spots. Douglas, thank you for joining us.
Thank you, Hall.
Great. Can you tell us about your background before investing in early stage?
My background is mostly consumer products and services. Came out of college and worked for publicity firms, some large firms, doing some tech stuff. Went from there to high-end consumer goods like Bentley, Lamborghini, Vespa. And from there, went to sports marketing, ran Nike, Motorola and Direct TV, large activations around big events, Super Bowls, Indy 500s, US Opens. And then from there, had a stint with a motorcycle design firm. And that's kind of when I got into the really nitty gritty of manufacturing and distribution of physical goods, less the fly on the wall, but more on the hands-on side. But then started a tech company with two friends called Fame Hog. That just a lot of lessons were learned there. And that was my first real exposure to venture capital. When I came out of that experience, a lot less capital in my wallet after that. And started making stews, gumbos, and jambalayas. Had the dream to bring them to market in single-serve pints. And that's when I realized there was no one, 8 years ago, very few groups were funding early-stage food and beverage startups. Yet the consumer was moving in a healthy position, or healthy direction. So I guess what I was getting at is that the consumer was moving and the finance hadn't caught up with it. So that's when I decided to put the stews on the back burner, all pun intended, and create a venture capital fund with no experience in finance and play a funding gap. And that's what we did. That's why I got into starting a venture capital fund called Gastronome Ventures. And that was the start of my investment experience in food and beverage. It was in 2009, 10-ish.
And so for those who want to invest in CPG or consumer product goods, what's your advice for people that want to do that?
Broad question. For those looking to invest in CPG, have realistic expectations. I think that's probably a very broad, candid advice, but food and beverage, venture capital was created in tech, where unit costs aren't really a consideration. Scalability is quite infinite. The same isn't so in consumer goods. There are unit costs, there's manufacturing, there's distribution, there's retail environments. It's just a much different path to growth, and it is very costly. There's an irony that the faster you grow, the more cash you need. So for those groups that are growing incredibly fast, they are in considerable capital suck. So there's, depending on who you are and what your risk return profile is, maybe consumer goods isn't for you, or maybe those high growth companies aren't for you. Maybe you're better suited doing something that's a little slower growth that has a little less risk. So it seems to be a bit outrageous right now.
You talked about the industry evolving in CPG. Can you talk more about that? Where do you see it evolving to, and what's driving it?
The root is for where the consumers are going. The industry has been evolving for the marker I put down is that Supersize Me. I think that film started to open people's eyes. Couldn't tell you when it was actually released, but from that moment forward, we started to see a little bit more narrative in the public discourse around eating healthier, what you ingest is how you feel, and that type of attention to food. And then the internet just democratized access to information. So the biggest shift is that consumers are demanding healthier food, and they have this unprecedented transparency and ability to push back on major manufacturers to demand quality ingredient and a quality product. That two-way communication that the internet provides is powerful. So with that being said, I don't know anybody who says they don't want to eat healthier. So now it seems that the access is growing. Before, Whole Foods was really the only national show in town, and you had the regional healthy food natural grocers, and Costco and Albertsons and its various companies. They're all moving into healthy food. TJ Maxx has a food buyer. Dollar General is moving a lot of grocery products all of a sudden. So maybe not all of a sudden, they're just doing well. So that aspirational element of healthy food is going to every part of the retail environment and every segment of consumer.
So based on that, what is your investment thesis for this sector? Where do you think the wins are going to come from?
Where do I think the wins are going to come from? It depends on how you define wins. And this is, I think, where we differ from most other folks. I originally started with a venture capital fund called Gastronome Ventures. This was 9 years ago. And it didn't feel right making short-sighted decisions from a board level to get quick revenue gains while not addressing the real cause of the food supply issue. And when I had the fund, a win was considered selling and exiting to a big food company. And I didn't understand why taking a healthy food company, a good company, and selling it to a shitty food company was a win for anybody other than just some shareholder value, which is good in one respect, but there was only so many buyers in the food space. Unlike tech, we have about 11 major buyers in food. So I don't think they should control all the food. When you have that kind of consolidation with our food supply, which is incredibly valuable and important, I don't foresee a win in the future as to having a big exit. I think food demands a bit more attention. We should have some more independent companies. So my whole thesis is, how do you provide capital that is independent from exit-driven returns? So I spend a lot of my time talking to family offices and strategic acquirers, folks that are inherently risk adverse, on how to invest in earlier stage companies to see those gains, but in a risk-adjusted manner. So we use a structure called an equity line. It functions like debt, but it's collateralized with the ownership shares, preferred share class. It works off distributions. And as we see more distributions based off our invested capital, we are able to ratchet back those distributions and provide the founders a larger piece of a bigger pie. It's a bit of a fallacy that a smaller piece of a bigger pie is better. We can actually offer a larger piece of a larger pie because the family offices we're looking for are not looking for the big wins. The home runs have been done. They've generated their wealth. They're typically in a wealth preservation, trying to see how many generations can live off that original nut. So we can give them ongoing cash flows in perpetuity in a lower risk manner up front. It's founder aligned. We're able to tell a founders very much like an actor taking a smaller fee up front for a larger part of the box office. The studios want a lower risk investment up front, and they're willing to give it the larger back end to the talent. It's the same scenario here with us. So the thesis simmers down to creating iconic independent brands, because I believe we need more independence in our food system. When we have 15 to 20 Chobanis in our food system, they can make decisions that are based on a long-term vision. They can reinvest in their supply chain. They can make investments in infrastructure that have far-reaching environmental impacts. We're not looking to see quarterly profits juice every 3 months.
You're looking for real win coming from achieving democratization of the food supply. It's more of impact investing as opposed to just financial investing. And there's a lot of investors very interested in that space right now. And the real win is the creating another iconic independent brand that's just not another Me Too product, but something that really fills the shelf with something unique and different out there. And how often do you see that happening these days? Is that happening in increasing fashion, or is that still a very rare thing?
I'd like to address the impact investment statement. Very rarely have I seen an impact fund that doesn't have a 10-year horizon on it. And when you're talking about changing long-term systemic problems in our food supply, it doesn't happen in 10 years. It doesn't happen in the 3 to 5 that a fund needs to exit. There's a lot of activity right now in these alternative proteins, the fake meats. So I don't think Americans are going to stop eating meat anytime soon, where those initial venture funds are going to see any sort of return on their capital. It's probably just going to be the big meat producers getting things for a pretty considerable discount. So we can't address long-term problems with short-term cash. And unfortunately, most of the impact funds or the underlying paperwork is the same functions as a normal fund. So the timeline is what I have concerns with. So Me Too products are fine. If they just want to be local regional players, there's plenty of capital and returns being made with regional players. Unfortunately, there's a narrative in the news that you got to build a company and sell a company, and it's very sexy to raise really large rounds of capital. It's not sexy when 99 out of 100 get written off, but nobody really tells that story. So I'm indifferent to the category. It's more about the values of the founding team and the actual underlying business. Is there a way to see return of capital through distribution? How long does it take us to get the distribution? Many times the deals we're looking at, our actual cash investment is less than the book value of the company, which covers a lot of our downside. That's the compromise that we have to make with founders, is that the families that we work with don't want to play the venture game. That's inherently risky. So how do we offset the risk up front for the founders to have a larger piece on the back end? And that is the compromise of what we're presenting.
How long does it take to affect real change if 10-year funds are not going to scratch? How many 10-year funds in a row does it take before you think you really do see real change?
How many years it take to change human behavior when it comes to eating? I wish I had that answer. It's hard to get middle America to drink fruit juice right now. So I don't know how long it's going to take for them to eat fake meat. Not them, but those are big statements. I get the nobility around why the alternative protein market is evolving. I just have a question on who's going to fund all the losses until the actual critical mass of consumers takes hold. There's a gap that I see, and I don't know who's going to fill that. I don't know what happened to those businesses in the meantime. So I don't have a crystal ball. I wish I did.
Right. It appears like it takes a long time. We didn't get into the current situation overnight. It took many decades to get here with the obesity problems and diabetes and others from poor nutrition, and it'll take equally a long amount of time to get out of it. And it was just curious if you had any sort of indication of, is it 20, 30, 40 years? And it's certainly a journey. It's not going to turn overnight, because once people have certain habits, they take those habits. I think the issue is that the generation that comes up behind aren't necessarily ingrained in those habits, and they're choosing better. I see millennials making a lot better food choices than the boomers. And as the boomers age out and millennials come into place, that shift will happen. But that's a generational shift, it seems. And to your point, impact funds will have a little bit of an impact along the way, but it's many of those, not just one of those, that's going to turn the corner for the population. But certainly the opportunity is there.
If it's helpful, we run an 18-year model. And that sounds outrageous, right? Because you can't see that far in the future. But the mechanics are the same of our distribution profiles and the function of how we work our deals with the equity line. So that's our window.
Right. And that was kind of my question is, there's financial models and then there's impact models. And the financial models are typically historically based on 10 years. And that's about how long it takes to start, build, grow, and sell a company, and you have an episode, so to speak. But impact takes much longer than that if you're moving large parts of the population. And there's easy parts to move and hard parts to move. And like I say, the millennials are the ones that are easy to move because they're gravitating to these changes, while the existing generations are probably never going to change. So, but at some point they'll age out of the process, and we'll have a new population to deal with new issues, of course.
Yeah. The conversation we have with most of the families I engage with is, again, it goes back to somebody in their family tree made a considerable amount of money. And it's not about getting another big win under their belt. It's about ongoing capital available for future generations. And how does that work? So when I talk to them, I say, hey, we're not going to shoot for the moon with these investments. We're going to look for measurable growth in the standard timeline of the growth cycle of most companies in the food business. We're going to glean distributions preferred to us, and kind of a heavier distribution up front to see the return of capital. But over time, our distributions will diminish to a 10% distribution over time in perpetuity. So I ask the families, what if you could have 10% of the next 25 Chobanis? Give us 18 years and we can get you close. And that starts to make a pretty robust return. It's just that ongoing, slow, measurable growth with profitability. It's fundamentals. So I'm not asking our families to place a bet and say, hey, let's go try to sell this next company for 300, 600 million to General Mills. I'm saying, let's take our time, act like a bank that has the value add of private equity, bring resources and leverage to these earlier investments, and over time, have a fully diluted position at 10% in 25 of the biggest independent food companies in the nation. That takes time. That takes about 18 years. So that's the proposal. And what does that look like for future generations? What if you were to get distribution proceeds from 25 of the largest independent food companies in the nation? That's a pretty compelling cash flow position.
Right. So you're advocating a move away from the traditional VC model of put some money in, take big equity ownership, and sell it on the pop in an M&A transaction, but more of a take a piece of the revenue and add that to your distribution and take the long tail out, because CPG companies tend to take longer to get up that curve than tech or healthcare companies because of unit economics. You have to fund all that inventory going up the curve.
I would agree with that. I would add one part is that in the earliest stages, when that initial investment's made, you cover as much downside as possible. So we put certain controls and protections in that if for some reason the company didn't take off or hit the growth trajectory that we're anticipating, we can cover the downside. That's, I guess, my largest learning from the last 8 years is that family offices look at deals inherently differently than venture. Venture's in the portfolio management. They're looking for the 1 in 100. A family needs to make every dollar generate revenue or some sort of return. So it's all about covering the downside. Now, sometimes you can do a larger investment into a company and have a lot more hard assets. We just did a deal like that recently. It was very interesting to see the perception of, okay, we'll do $4.5 million versus $1.5 million, but $3 million of that's going to go into a facility, equipment, trucks, and then inventory. So if you start to look at the business as a whole, that $4.5 million investment has a lot of coverage around it, not just $1.5 million for growth capital for marketing spend.
But it takes longer to run that game plan that family offices are running where they're covering the downside. They're what they call patient capital. They'll be in there longer and they don't mind being there longer. Whereas venture capital has this 10-year window, and in the first 3 years, you have to deploy the funds. Next 3 years, deploy again, and then last 3 years, harvest what you can, and then 10 years is up. So the accelerated cycle of VC funds don't really match CPG growth companies as well as they do some tech, I guess.
It works for a few. It fails for a lot more. And that's what's disheartening is after the last 5 years of, I'll call it voracious venture capital activity in the food and bev space, we don't have a secondary market in food. This is the first wave of real venture investment in food and bev. And so when the funds come up and they have to dissolve or they have to exit everything, there's a lot more divestitures that have nowhere to go. And unfortunately, those companies get written off. I'm getting a lot more phone calls around that from funds trying to get out of things while there's still some value left. And there's just I'm unaware of anybody who's picking up the pieces from this. And that we're talking about food and healthier food. These are companies that are buying healthier ingredients that are trying to stabilize the ingredients, supply chain side. And when they start to be written off, there's a ripple effect that just doesn't benefit consumers having access to healthier food. It's a financial game.
What about corporate VCs? The companies looking for the next innovation, buying these companies up because they're not so great at innovation, but they're pretty good at buying companies and then providing the distribution channel and all the other infrastructure elements to make it go big. Where do you see corporate VC coming into this?
Personally, I think it's a novelty. They're not putting enough cash into it to make any difference. It's an optic. Much of the founders I know that have taken some corporate VC have not gotten the resources that they thought they would get, which is totally understandable when you're dealing with a multi-billion-dollar company and your company is doing $3 million. It wouldn't get those kind of resources. So I don't think a company should take corporate VC cash. Personally, it kind of is a scarlet letter where if it doesn't work with that corporate VC, who else is going to touch you? Because the perception from the outside is they've had every bit of resource and they couldn't maximize the opportunity, which might not be the case internally. It might just be the case that they were the redhead stepchild and somebody else had a bigger fish to fry in the company. So I think it's good. I think it's as far as bringing attention to the space, but realistically, has there been many successes out of it? Maybe it's too soon to tell. I don't know. But just from a founder's perspective in the conversations I've had, the resources don't usually line up with what's been sold in initially.
Very good. Well, in the last few minutes we have here, what else should we cover that we haven't?
When I'm not talking to a family office, my other time spent talking to founders, and I think educating founders that there's plenty of patient capital out there, more than they could ever imagine. But it's really difficult to take a hockey stick growth exit comp pitch deck to a family office that's risk adverse. And that a lot of founders are just being educated and here's how you raise money. And they're only being told the venture capital way. And that's not. I'd say more money is in the private family office category. But yet nobody's really talking to these founders about how have you thought about risk? How are you going to take the risk out of this? If it means giving up a little bit more of your company for a really good partner, for a long-term partner, you should probably do it. This whole narrative around don't dilute yourself, I think it's overplayed. So as far as founders go, know that there's different types of investors, and they all look at risk and return differently. And that you should really have a heart-to-heart with yourself and your founding team as to what kind of capital you want. Venture capital is a zero-sum game, and I don't think many founders realize that. So you want to shoot for the moon and have that big exit, that is your path. For those that want to have some sort of meaningful impact and have some integrity of the product and their community, there's better capital sources. It just can't be the same offer you're giving the venture capital teams because they're looking at deals differently. That's really something that needs to be driven home more and more frequently.
Well, it sounds very good. It sounds like something to dig into further in the follow-on call when we get the chance. And for those who want to get back in touch with you, what's the best way for them to connect with you?
biasandblindspots.com or just Douglas@biasandblindspots.com.
All right. Well, we'll put that in the show notes and let people aware of it. And appreciate your coming on, and hope to have you back for a follow-up to dive deeper into these topics.
Thank you, sir. I appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.